Joining us more is Peter McGuire from XM. Pete, good to catch up with you on this Monday morning. So we take a look back at Friday. It was risk off. Clearly investors opting for those safe havens.
Absolutely, Andrew. And I'll tell you what, and good morning, happy Monday. Yeah, they did. And equities, the Nasdaq was up a little bit. It had a bit of a punch up, but the other markets, the broader markets were down. And then having a look at, where energy was and gold and all the currencies, US dollars continued to have a little bit of an uplift. So, yeah, it's going to be an interesting week how this one plays out.
Yeah, a week dominated by central banks, of course. We do have the Bank of Japan, the Bank of England, and of course the Fed.
Yep, the hat trick. I'll tell you what, it's not a bad trifecta, is it? And when you think where we're going to move, I think that there's no chance. Well, I'm not going to say no chance, but it's about 99.9% that the Fed's not going to move. But it's been interesting. It's really evaporated from even the start of the month, Andrew, as far as I think any chance of a hike. And I'm not saying that December's not going to happen, but at the moment, I think they're going to stand pat, and that seems to be the general mood. Interesting how BOJ will play. They might tweak policy, and I'm not expecting anything from the Bank of England as well. So, yeah, it's but we've just got to see the markets, how the market interprets it all, and what impact it has to naturally currencies.
And Pete, quite a bit of data coming to us from the States as well, which actually comes after that Fed policy decision, clearly rounded out at the end of the week with the non-farm payrolls report.
Yeah, first Friday of the month, and I think we're looking at around about that 190,000, Andrew, as far as our headline. So we'll just see where that rolls, and if it's going to be above that and significantly above it, then that would put a lot of fear into the Fed as far as policy. They don't want a hot labour market, so there's the first part. And the second part is, of course, how it all plays as far as trend and, as far as growth as well leading into Christmas. So, yeah, it's a very interesting run up to, the final 2 months of the calendar year.
So you mentioned the Bank of England. It is expected to sit pat, although there are concerns about stagflation emerging in the UK.
Well, you don't want higher rates because stagflation really is, high inflation, and then you're looking at what happens as far as yield. So, yeah, it's a very dangerous situation for the POMs, and they've got to try and, spend their way out, and it's a very delicate situation, with the high inflation and so on. So, it's not an enviable position for the POMs, and we've just got to see how that all, I suppose, moves forward very much into the first quarter of 24.
And to the Bank of Japan, I guess the question as to whether, we've seen the yen under so much pressure. Are they going to intervene, do you think, Pete?
Well, above that 150, everyone would have thought it might have happened, Andrew. It hasn't as yet, but they're probably, I'm not going to say I won't rule it out. And maybe this week is going to be the week that we see some action from them. That US dollar is certainly ticking higher. It's 105.5. Well, about that, I've got a number there and I've just lost it on my little board here, 106.58. So that US dollar's really ticking up, and if it hits a 107 or 108, then that's going to put a lot of pressure naturally on the yen, and I would think that the central bank would intervene. So yeah, they'll try and we won't be surprised. Maybe they tweak some policy. We've just got to sit here and just observe. And Mrs. Watanabe trading the yen, I'm sure she's having a great time.
Yeah, absolutely. Pete, let's look elsewhere, of course. So we've got the conflict in the Middle East, heightened concerns there, given that ground invasion essentially has begun, the Israelis versus Hamas, of course. That has seen that flight to safety. But let's first take a look at oil, because concerns, if it does spread this conflict, that will certainly impact supply.
Well, yeah, you've got to be mindful as far as, from a distribution standpoint, and around about 28 or 30% of all crude travels through the Strait of Hormuz, or the Persian Gulf, and one side of it is Iran, and the other side is UAE and a host of other countries, Oman and Kuwait up the end, and so if that was to create that sort of tension, then that would impact naturally prices because of as far as getting that to distribute that supply, and that would be a major handbrake for the price, because I think it'd push it sky high. And that's what we don't want, is a further war premium built into that. The second part is, what impact it has to the ongoing conflict and other commodities that might get a ratchet up as well from a flight to safety, and the fear of, being in a drawn out war across the Middle East.
Well, given that also, I mentioned that flight to safety, gold pushing above that $2,000 level.
Yeah, it's given up a little bit of steam, but yes, absolutely, Andrew. And, gold is decoupled in a lot of ways. That's what a number of analysts are, and, you listen to the economists and the people that I'm talking to, decoupled from real yields as far as treasuries. So, we've always been taught that gold has a negative correlation between gold and treasury yields or real yields, but it seems to have broken that. And at the moment, so we've just got to be, it's pretty hard not to have it in a portfolio from a physical standpoint, just to where it's capable of achieving over 24 with protracted wars and naturally uncertainty across the economic cycle.
Yeah, and that digital gold, Bitcoin also moving in that direction at the same time. Pete, let's just round it out. What we're seeing on equity markets at the moment, the S&P down about 10% in correction territory, obviously, since its highs in July. NASDAQ similarly also. What are we seeing on the local stock market?
Well, I think where it's running, Andrew, that 67, 68 handle, we're going to be, wherever I think the US and wherever the world goes, then we'll be probably in tandem with it, unfortunately. And, that just takes us down, and we've just got to see where we are again by Christmas. There seems to be a lot of concern as far as earnings in the States and the overall theme and yields the way they are. So if we see a rate rise here again, I suppose that puts a lot of temptation to investors to say, well, I'm far better just, parking money in the bank and, observing the market and not worrying about something falling, or naturally from a hedging perspective, what instruments do I use to protect my portfolio whilst the market is in a correction phase? And that's where tools and derivatives come into play.